So good evening, everyone, and welcome to Master Talk, a master trust effort to bring you closer to the market masters of financial services. I am Angad and will be hosting you all this evening. As we meet here again today, the markets have further surmounted previous record highs, and as an investor, there are multiple dilemmas clogging our minds right now. As an existing investor sitting on profits, the dilemma is whether to continue to stay invested or to book profits, which means whether we reduce equity exposure and rebalance the entire portfolio or to exit the equity markets altogether for the time being. While as a new investor or new funds which are sitting on the sidelines, our dilemma is how to approach a market which is trading at all-time highs, whether to go all in one go or to stagger the entry or to wait for some sort of a correction. And while we are all waiting for that all elusive correction, the dilemma only gets more and more difficult with each passing positive day in the markets. Hence, our discussion today will look to provide insights into the above and many more questions that we all investors face in such volatile and one-word movement times. With that, I welcome our guest for today, Mr. Manish Jain, who's the fund manager at Ambit Asset Management. So Manish is the fund manager for the very popular coffee can PMS strategy at Ambit Asset Management. He has over 16 years of experience in equity research. Prior to Ambit, he has worked with Nomura for a decade as a lead analyst. Prior to that, he's also worked with organizations like Lehman Brothers, Enam Securities, ICICI Securities, and Motilal Oswal in the equity research space. He's also been consistently voted as the best performing analyst by organizations like ADIA, Capital World, and Capital International. Manish is also a level 2 CFA and holds an MBA in finance degree from SCM HRD Pune. To all the participants, please type in your questions. We would want to answer most of them during the course of this presentation. With that, it's over to you, Manish.
So thanks, Anand. You've summed up the whole dilemma beautifully, right? I mean, the whole point essentially being that markets being where they are at around 17,500 now. If human memory is short-lived, but most of us do not even relate to that time frame anymore of the last week of March 2020, when the market had crashed down to 8,000 levels. And just imagine if somebody at that point of time, when all of us were panicking, right, as to what to do with our equity investments and how quickly to sell them and how to liquidate the portfolio, right? That's essentially the whole idea everybody had. And at that point of time, if somebody told you, sorry, yeah, fair point, I forgot to switch on my video. Thanks for the reminder. So if at that point of time somebody told you that the markets are going to double in approximately 15 months from that time frame, I think most of us would have found it very hard to believe. So what I'll try and do here is in the next around 1 hour or so, I'll take a presentation, we'll take question and answers from all of you guys. And I'll try to answer two very important questions. One is, why are markets as high as they are? And why is the Indian equity market on fire? That's point number one. And I think point number two, which I'll try to answer, is what to do at this juncture, at this point in time, when the equity markets are really on fire. So Prithvi, if you could just share the presentation, we'll start right away. So when you look at this presentation right in front of you, the first slide, Thanks, Prithvi. So the first slide obviously is that the Indian equity markets have really been on fire, right? When you look at the Nifty mid cap and the BSE small cap index, FY21 we've delivered 71% return, 102 and 115% returns, right? This year alone, this calendar year, CY21. When you look at it, Nifty is up almost close to 25%. The mid-cap index is up about 45%. And the small cap index is up about 55%. And it's not just one sector or the other, but the rally is massively broad-based, right? When you look at, for example, sectors like metal, technology, PSU bank index, the public sector enterprises index, the real estate index, the infra index, and the energy index, all of them have managed to outperform the Nifty by a very wide margin. Right? So it has been a fairly broad-based rally, and it has been very different than what the rally of the past has been. If you remember the previous bull market cycles between 2013 right up to 2019 end were driven more by structural growth stories. They were driven more by stories where you could get that assured 8-10% kind of a revenue growth and around 15 to 17% kind of a bottom line growth. So FMCG companies, autos, pharma, media, right, private sector banks, those were the sectors that were performing, and the multiples continued to expand through long periods of time. But this time around, it has really been difficult. Now, when you look at this in conjuncture with the global markets, and you'll see that in the next slide, you'll realize that it's not just the Indian equity markets which are doing well on a standalone basis, but India is actually one of the best growing markets in the world at the moment where we are standing. Prithvi, if you could just go to the next slide. Yeah, thanks. So if you look at this slide over here, you'll realize that on a YTD basis at 25% performance, when you look at India in comparison to S&P, Dow, when you look at it in conjunction with NASDAQ, when you look at it in comparison with the European markets, when you look at it in comparison with the other emerging markets, which is Nikkei, Shanghai, Hang Seng, we are actually one of the best performing markets YTD. Right, and even on a one-year basis, right, we are amongst one of the best performing markets. So it's not just that on a standalone basis this rally has been very massive, but even on a relative basis as compared to the rest of the world, Indian equity markets have really been on fire, and they continue to be so. Right, it's not just 1 year or YTD. When you look at the monthly performance, when you look at the weekly performance, and when you look at the daily performance, right, which was the end of yesterday, you realize every single time frame except the 3-year period, the Indian equity markets have actually been on fire, and they continue to remain on fire. And what is astounding is if you go to the next slide, you'll realize that this is not a rally which has been just about quality stocks, right? But even the worst of the stocks, right, even some of the worst quality stocks, essentially what we've tried to do here is to make a penny stock index, all the stocks that are less than 10 rupees and are trading in the market. And then you look at the rally, right? The last rally in penny stocks, which happened with the same intensity, was around 2009, 2010, when in a matter of 615 days, the penny stock index had rallied 245%. Right, and now when you look at it in this current time frame, what has happened is penny stock index has rallied close to 240%, but in a much lesser time frame. Almost the same intensity, but the gradient and the slope is much steeper, which is 645 days. Right, and this kind of a rally has never ever been seen before as far as penny stock index is concerned, at least not from 1995 till now. So it has been a fairly broad-based rally. It has, been a rally that has been fueled by a resurgent India, by a hope of a proactive government, which is more intent on spending money to fuel growth. A rally which has been driven by the behavior of Reserve Bank of India, which is more intent on pushing aside inflationary concerns and still continuing to maintain low interest rates. And it's a rally which has been fueled by many other factors. But one of the bigger things that have happened is that the multiples of Indian stock market has actually gone up. And that's something that not too many people have noticed. If you look at the next slide, it presents to you a very interesting picture. You look at the market capitalization of Indian markets. Now, we took 10 years to go from $1 trillion to $2 trillion, from May 2007 to May 2017. We've gone from 2 trillion to 3 trillion in a matter of 5 years, right? Now, when you look at it, it all seems very counterintuitive because when we went from $1 trillion to $2 trillion, The returns as far as Nifty in terms of CAGR concerned was 8%. And the nominal GDP growth rate, if you see, was much higher at close to 14%, right? And the rate cut in terms of repo rate was actually much lower, from 7.75% to just about 6.25%, which is about 150 basis points. Now you look at the next $1 trillion which got added, which at that point of time, our Nifty returns were 1.5 times at close to 12%, but the nominal GDP growth rate plummeted from 14% to just about 6%, right? And the repo rate cut was actually the sharpest at around 2.25%. So when you look at the journey and the way, market cap to GDP has hit 100% number, right, today, you realize the multiples have actually expanded, and India as a country and Indian equity markets as a class can no longer actually, be valued in a way that they have historically been valued. We have to learn to value these markets and these stocks in a different manner. Conventional valuation methodologies are incrementally going to fail us. And the primary reason of it is going to be the new IPO pipeline that we are seeing. When you look at the chart on the right hand side, you realize how many unicorns are about to be listed or are going to get listed in the near future. There is Byju's, there is Paytm, there is Oyo Rooms, there is Ola, there is Dream 11, there is Swiggy, right? And then there is one more which is missing from this list, which I should have added and I forgot, was Nykaa. And what you'll realize over here is that none of these companies have E. There is no earnings, there is no EBITDA, there is only price. And a company like Swiggy trades at a multiple or a market cap rather, which is double than that of Jubilant FoodWorks. Jubilant FoodWorks trades at close to 50,000 crores. Somebody like Swiggy trades at close to 1 lakh crores. And there is no EBITDA and there is no earnings, and it is not going to turn EBITDA positive this year or next year either. Now, the question is, how do you value these companies? You'll have to unlearn to learn first. And you have to unlearn to look at PE multiples or EV biota multiples in historical conjuncture and say that these markets are expensive and the rally has been massive and there is incrementally very little money to be made at this point of time. What you really got to do is to look at valuations and look at markets afresh, right? And risk versus reward is what you got to measure from a long-term perspective, that growth versus valuations, are they making sense in conjuncture with each other and not on a standalone basis? Because as more and more unicorns get listed, these multiples will continue to go up and the valuations are going to continue to look more and more absurd. If at 22 to 23 times market is looking expensive today, believe me, when the Nifty hits close to 24 to 22,000 next year, these multiples are only going to expand and it's going to look even more absurd, right? And what market told me between 2013 to 2019 was that it can remain irrational for a far longer period of time than what we can remain sensible. Right? So do not, first thing is, just because the market has rallied to a certain extent that it has, and just because the multiples have come to a certain level that they have, the first point that I'm trying to make over here is that do not believe that it's all over and that there is incrementally no more money to be made. You got to look at things afresh. You got to look at things from a new perspective, a perspective which is devoid of any baggage of the past. Right? And look at risk versus reward and see if things are making sense in absolute terms rather than looking at it on a relative basis. Now let's get into the reasons in terms of why this rally has been fueled and what is leading to this rally. So if we move to the next chart, right, what has led to this strong rally? So point number one is liquidity, flows. Now you look at the intensity or the way in which the FIIs have continued to buy Indian equities, right? When you look at 2019 numbers, when you look at 2020 numbers, and when you look at the numbers on a CYTD 2021 basis. Now, what is very interesting is in August, for the first time, right, you'll realize that all three have turned cash positive now in terms of inflow. FIIs, DIIs and mutual funds. The flows have turned positive for all of them. Now, it is this flow or liquidity from FIIs and DIIs and mutual funds, which is essentially a big point, which is fueling the rally. Now, when you look at FDI inflow, surely a lot of people will tell you that there have been a lot of outflow from the Indian equity markets in CY21, from 18 billion to close to 27 billion. But a large part of that is because of the IPOs getting listed and a lot of these Ps and VCs, finding an outlet to sell their stake. But when you look at it in terms of the gross inflow, I think the number continues to move from strength to strength. What was 34 went to 60, 62 range, and now today stands at 82 and will continue to move forward from here onwards as well. But this is not just on an India standalone basis. When you look at the inflows in India in comparison to all the other emerging markets as well, right, you'll realize that India is probably one of the emerging markets which is standing out. When you look at the next slide, when you compare India with, say, something like a South Korea, you realize FIIs have been continuously selling in South Korea. You look at the numbers of South Korea from January, February, March, right, and May, June, July, and then now August. They have been continuously negative as far as US dollar billions are concerned in South Korea. And the flows incrementally in China are also reducing. And all of that money incrementally is coming into India and will continue to come into India. So when you look at India in comparison with some of these other emerging markets like Taiwan, for example, South Korea, like for example, Indonesia, and when you look at it in comparison with China, India kind of stands out. China has its own concerns, right? China has got tougher rules on data privacy law. Initially, they clamped down on educational businesses, and now they are kind of clamping down on unicorns, and I think that has really spooked the FII investors and FDI investors in terms of what is going to be the next target. Korea has its own issues. It is an export dominated industry. A slowdown in China and the chip shortage from Taiwan doesn't help that. The real interest rates in Korea are negative. There has already been one rate hike, and the markets are waiting for more. So that kind of takes another toll. While in India, the PMI continues to move up from strength to strength. The inflation trajectory has come down, and the GDP growth rate continues to remain on a very solid and a firm footing. Right, even on a in a quarter like the first quarter of FY22, you'll realize that the growth was a very solid 20.1%, despite multiple states being under a complete lockdown through the month of May and a large part of the month of June. So almost for 1.5 months, 60-70% of the country was under a lockdown, and yet you kind of clocked the growth that you did, that the economy shrank only by about 2% on a 2-year CAGR basis. I think it's a real feat in itself. So one big factor that we've studied on why the markets are as strong as they are is liquidity, which is the flow from FIIs and DIs. The other bigger factor, reason number 2, is the way retail money is flowing into Indian equity markets. When you look at the next slide, you'll see retail participation. Now, first chart to look at is the chart on the bottom left-hand corner, which is systematic investment plans, SIP flows. Pre-pandemic, the number was close to 8,500 crores in terms of SIP flows. That's today standing at 10,000 crores, and the number has continuously and consistently kept moving up. But more importantly, when you look at this number, which is the number of demat accounts being opened, right? We had an average of close to 2.7, 2.8 million accounts being opened, demat accounts being opened every year between 2018 to 2020. Last financial year, the number stood at 12.3 million, more than the combined number between 2016 to 2020, right? And almost 3 times the run rate. And this year, in the first 3 months, we've already had 6.2 million demat accounts already being opened. So the number of retail investors who are looking to participate in the market is moving up. That is also visible when you look at it in terms of the IPO subscription applied money. When you look at the average between 2016 to 2020, in arguably the best year that we had was 2018, when the number hit about 600 billion INR. Last year, the number stood at 772 billion INR. Probably the best year we had in terms of IPO subscription applied money in a matter of 6 years. Now, this year in FY22, in the first 3 months, we have already crossed 614 billion. And you look at the way individual holdings have moved up by almost 1.1% across the listed universe. So it's not just FII money which is flowing in, but I think the second big reason why Indian equity markets are behaving in the way that they are is essentially because of the retail participation and the way the retail money is flowing into the Indian equity markets. The third reason, and very importantly, is the corporate behavior or the deleveraging that is happening as far as the corporate India is concerned. So if you move to the next slide and you look at the charts therein, you'll realize one thing very, very significantly is that during the pandemic, I think one big factor, which pulled us out as quickly as we were, and the recovery was as V-shaped as it was, primarily was the corporate India behavior. Everybody pulled up their socks. Everybody got ready to respond to the pandemic. And the first point of attack was to cut costs, personnel cost and non-personnel cost. And all the incremental margins that you made, and everybody, believe me, sitting on lifetime high margins, irrespective of the sector that you look into. All listed companies have got their life high margins right now. And the money was used essentially either to hoard up as far as cash in the balance sheet is concerned, or what they have done is that they have used that money to repay the debt. And that's all what you've done. So when you look at CY, FY17 to FY21, the aggregate debt has risen in the Indian economy only by a matter of CAGR of 5%, which is much lesser than the revenue growth and the bottom line growth that the listed companies have recorded. Or second is, if you look at it from a perspective of top 691 companies, which is the top 1,000 companies X of BFSI names, then you'll realize that the deleveraging has been to the extent of 20%. Companies have repaid their debt 20%. So not only is your P&L in terms of revenue growth, in terms of the profitability, EBITDA margins, it has is in a very, very good position, but also the fact that your balance sheet today is much stronger than what it has ever been historically. And I think this behavior of corporate India is actually one of the second bigger reasons in terms of why the markets are in the way and being in the ways. The third piece, or the pack in the joker, is essentially agri. Now, is that we've had a wonderful monsoon for the last 2 years in a row. Right, the actual has been very close to the forecast, and we've had above normal monsoons for 2 consecutive years at 110% and then 109% for 2 years in a row. And what helped us were 2-3 things. One is that the government's behavior in terms of increasing the allocations towards Narega, and more importantly, what has helped the rural a lot, right? A lot is the MSP increases have changed, and not too many people have actually noticed this. But when you look at it in granular detail, what you'll notice is that the cash crops in terms of wheat, paddy, etc., are still in that low single-digit range as far as minimum support prices increases are concerned, which is about 3 to 5% range. But when you look at the non-cash crops like jawar, bajra, etc., the MSP increases is actually in teens. It's anywhere between 10 to 15% over there. So what the government is trying to do in an effort to double the farm income is not just increase the irrigability of the land across the country, but also what they are trying to do is to incentivize more and more farmers to switch from crops where there's already an overcapacity and those kind of crops are bought by FCI and they rot in the FCI, go down into other cash crops, which also kind of then promote a healthy lifestyle. And that fuels a lot of growth. Now, agri as a sector might look very small to you on itself, on the face value, 18% of GDP contribution. But when you look at it from a $2.5 trillion economy size perspective, at 17-18%, the share of agri in absolute term becomes close to $400 to $450 billion. Right, and when agri grows at the pace that it has in the last 2 years, in terms of 5% in CY19, and then again 3.8% last year in 21, for 2 consecutive years, around 4% CAGR positive growth, 4.5% positive CAGR growth, you are adding anywhere between 12 to $15 billion of money flow into the agrarian economy. And a large part of that money is going into consumption of tractors, consumption of gold, consumption of discretionary products, utility vehicles, etc., etc. And that is why when you look at it, the share of rural in the overall consumption growth pie was systematically declining from 2014-15 right up till 2019-20, has actually taken a V-shaped recovery. And we've come to a juncture where rural is actually back again, growing at double the pace that urban is growing. Right. And that has really helped a lot in terms of not only keeping the growth engine going, but also in terms of fueling the growth as far as the overall economy is concerned and the listed universe is concerned. Now, the fourth reason is the flow that has happened and the way cyclicals have behaved. Now, when you look at two different timeframes of the Indian economy, and you'll notice they're very different kind of timeframes, which is CY 10 to 20, and then there is CY 4 to CY 10. We've distinctly chosen two different timeframes. Why have we chosen CY 4 to 10? CY 4 to 10 was a time when the Indian economy's engines were on fire. We were clocking 9% plus growth every single year for 3-4 years in consecution. We had the golden quadrilateral, we had the north, south, east, west corridor, and things were really going great for us. Right, our nominal GDP growth rate at that point of time was close to 14-15%. And then you hit a patch of CY 10 to 20, where everything kind of slowed down. In the later half of the decade, the growth as far as nominal GDP is concerned plummeted to 8-9% levels, and really nothing was going wrong right for us, and we were going from one catastrophe to the next, right, oscillating. You see the kind of stocks that rallied when we were in CY 4 to 10 period. You look at metals, you look at PSU banks, right, and then you look at the period of CY 10 to 20, and you see the way FMCG index, and the consumer durable index and the IT index behave, right? So defensive stocks typically will behave, perform well in a low growth era, but high beta, low P multiple stocks will typically be firing on all cylinders when you are in a high growth era, which is close to CY 4 to 10. And that's the phase of the Indian economy where we are entering again. And that is why you see PSU banks outperforming private sector banks, metals outperforming FMCG. And that's a rally that has come back after a very, very long period of time. And I do believe that, the fundamentals of the economy are in place, right? And that's something that I feel is taken for granted. I think we are all in acceptance of that reality, that Indian economy is poised to grow at 7 to 8% pace over the course of next 3 years or so. We do not foresee any kind of hindrance at the moment, not even the third wave. And if that is going to happen, then the Nifty earnings are going to continue to compound at anywhere between 13 to 15% pace in that same time frame, which essentially means that you are going to witness a market rally, which is going to be above that number of 13 to 15% in the same time frame, as we believe that the multiples are going to go up. Right. So that's essentially the 4 reasons because of which the markets have, rallied the way in which they have. Number one is the flows from FIIs. They continue to buy Indian equities through the last calendar year and part of the early part of this calendar year, when we were coming out of the first wave and just before we entered into the second wave. Retail participation has gone through the roof from every perspective that you look at it. Corporate India has undergone a massive amount of deleveraging. Agri is another big reason because of which these have gone up. And the culmination point of all of that is cyclicals have outperformed, low P multiple, high beta stocks have outperformed. Now, the real question is, what should the investors do at this juncture, right? So first thing, what you should do is to invest in stocks, invest in portfolios that give you steady returns over long periods of time. Now, why is steadiness of returns in a portfolio important? Because as investors, you're not going to be able to time the market accurately at all the points of time. Remember, when you are buying a cyclical stock, what you need to do is to enter at the right time and then exit again also at the right time. If you're going to be investing in a stock like Reliance Industries and you're sitting in 2020, make sure that you invest in May and then you exit by August. If you hold on till December, or if you continue to hold on to it, till March or April of 2021, you're going to start underperforming again. And if you bought it in 2016 and continue to hold it till 220, then you're actually still probably sitting on very nominal returns, right? And not really made too much of a money. And for a large period of time, your returns were in the negative. Now, the best of us managed to time the markets accurately about 7 to 8 times out of 10. The best of the fund managers. 2 to 3 times, even they go wrong and it becomes a zero-sum game. So what you do is have an aim in mind, which is that I need my money to compound at a certain pace, which is X, Y, Z. And that needs to be very individualistic to you. And then stick to that goal. Don't look for relative performance. Okay, look at absolute returns which are compounding in that pace. What we do in Coffee Can is set a target for ourselves of 15% plus. Right? 15% plus, we give a target to ourselves that every calendar year we are going to deliver a return of about 15 to 20% in that range to our investors, so that the money kind of doubles every 3.5 years. The money goes about 6 times 10 years. The money goes about 30 times in 20 years. That's the aim that we've set for ourselves, and we are happy with it. And that's why when you look at the chart above, what you'll notice is that through periods of time, which is essentially a good year like 2017, 19, 20, 21, we have delivered those double-digit returns. But even in a bad year like CY18, what we've done is we've delivered that 15% return in a year when the ILFS crisis happened, in a year when the large cap mutual funds delivered negative returns, in a year when Nifty delivered only 3% return, Coffee Can still delivered 15% return. Right? And that is what you do, just to get a good night's sleep. Let your money compound at its own pace, at its own journey. Be a long-term investor in equities. Do not look at historical track record and fall into the trap of greed and fear. That's the biggest mistake that I think all investors do, that they fear when the market is at 8,000 and they get greedy when the market is at 17,500. You shouldn't be doing that. You should be agnostic to it and value each opportunity on its own fundamental basis, devoid of the history that it has had, on its own merit in terms of the risk versus reward, where it is standing at that juncture. And that's a call as far as equities that you take. Second is what we call as a 4 pillars of discipline, right, of investing. That's the goal that we set for ourselves. When you look at the next page, what we do is 4 things. And we really believe in this headline that you read over there, which is good risk-adjusted returns are an outcome of good processes. And what are the characteristics? And this is something that all of you should try and imbibe as much as possible in your daily investing habits. Number 1 is, when you're investing in a fund, do not go by historical returns. Historical returns are only an indication of how the fund has done. There is no guarantee in terms of return that it is going to generate in the future. So it's a misnomer. But what you should look at is what is the overarching philosophy that the fund has. And the point that where and at what point of time did the fund deviate away from that philosophy, or did it ever deviate away from that philosophy or not? And if the fund has the guts of sticking to its philosophy through periods of turbulences and through periods of euphoria, then that's a time-tested quality portfolio, which is going to deliver to you what they have promised. Second is research capabilities, which is very, very important. There is no substitute for hard work. So each idea that is included in the portfolio, each idea that comes into the portfolio should really, really make a difference, right? As far as the capabilities are concerned, as far as the homework that you do. So you should really, really do a lot of hard work, a lot of research. Do not go by momentum. Do not get swayed by hearsay. Do not invest in something just because somebody invested and somebody's friend made so much money in that particular idea. And third is, behave like a business owner and not like an equity investor. Think of it. If you are a promoter, would you be buying that company? Would you be buying that business out or not? Be obsessed with the profit growth in the company and not with the stock returns. If the profits continue to grow at a steady pace, believe me, the stock returns will automatically follow. And this is something that we will prove to you in a couple of minutes. And fourth is risk mitigation. What should be your risk mitigation strategy? You don't need any risk mitigation strategy. You need only one risk mitigation strategy, which is discipline. Do number 1, 2, and 3 with a lot of discipline, and you'll see the results coming through automatically. And this is something that we've done for the last 4.5 years. And that's why we managed to deliver a good 23.5% kind of return on a compounded basis since inception. Right now, talking about an overarching philosophy, when you move to the next slide, I'll take about 30 seconds on this slide. This is our time-tested framework. This is what we use, as a guiding principle. We invest in companies that have delivered historically with consistency of growth and consistency of wealth creation. And we look at a very long-term history, which is 10 years. And if the company has not been consistent, we do not invest in those companies, right? Believe me, when we run this filter across the listed universe of all the companies that have a market cap of 400 crores plus, there are only 50 to 55 companies that make the cut. That becomes our coverage universe. So that's the playing field that we've set for ourselves, and that's the kind of discipline that we bring to the table. I'm not saying that that's the kind of framework that you need to set yourself, but have some kind of a discipline, have some kind of a framework with which you go by. That's number 2. Number 3 is earnings growth. When you look at the next slide, you'll realize, you'll see the earnings growth performance of Coffee Can, and you'll realize that across time frames, we have delivered, growth which has been much higher than the market. In the current quarter, which has gone by, 51% weighted average sales growth. And on top of that, it's not just revenue growth, but margins expansion also, and a very healthy margin expansion, 105% EBITDA growth, leading to 87% kind of a bottom line growth, much higher than the benchmark index, right? And when you have a portfolio where the earnings are growing consistently, when you see the next slide, you'll notice this, is that the returns automatically follow. When you look at Coffee Can, between 2011 right to 2021, there have only been 2 years when we've delivered single-digit revenue bottom line growth. Otherwise, in 8 out of the last 10 years, we have delivered double-digit profit growth, as compared to Nifty, which has continued to remain in a deceleration zone and has delivered double-digit bottom line growth only in 3 out of the last 10 years. And what has happened to the Nifty multiple? It has kind of remained range bound for a very long period of time, between 19 times to 20 times, for a period of almost 9 years, from 2011 to 2020. While when you look at Coffee Can, multiples continue to go from strength to strength. And at every juncture, people kept talking about it being expensive. People kept talking about the multiple expansion story being over, and that continues to go through. So the point is, higher EPS growth trajectory will always lead to multiple expansion, because quality always comes at a price, and the market always rewards you for your consistency. So if you have a portfolio where the bottom line growth is growing at a consistent pace, then automatically the returns will follow, and the returns are going to be much more superior than what you or anybody else envisages. As a parting slide, before we take up the question and answers, what I would want to do is to give you 5 pillars of a good portfolio. Number 1 is look at consistent track record historically. Right, we look at least 10 years history of a company for consistency. Number 2, be a long-term investor. We invest in a portfolio company from a perspective of at least 10 years. You guys should do it at least minimum 3 years to 5 years. Number 3, have a low churn. Our churn ratio in the last 4.5 years has been close to 8% or thereabouts. And we have a very concentrated portfolio of 10 to 15%. Never have more than 15 stocks, never have less than 10 stocks. Fourth point is, do not try to time the market. Try to spend as much time in the market as possible. And fifth and most important point is, have a B2C orientation in your portfolio, because you will not be able to time the B2B stocks correctly all the time. And the result of that is going to be the chart that you see on the right hand bottom corner, which is the quality of the portfolio is going to stand out. When you look at the coffee can portfolio, 14 out of 14 companies are all either segment leaders or industry leaders. And when you look at it from a market perspective, 12 out of 14 are either pure monopolies or oligopolies. So that's where we stand, and that's the quality of the portfolio, that coffee can brings to the table. So that's essentially what I wanted to say, that markets are at an all-time high, but there is a lot more money to be made as far as equities are concerned. Do not fall into the trap of fear. The story has just started. The bull market has just started. There is still a long way to go. You will see Nifty touching 18,500 this year. You will see Nifty crossing 22,000 next year. And polarization as a theme is going to come back in a big way. People are going to continue to talk about valuations being expensive, and yet the market is going to continue to run. Fundamentally, why? Because the flows are strong, because retail investment participation is there, because corporate India is benefiting out of a very strong balance sheet position where it is. And second is formalization, which is also happening in a big way. And when you put all of that together, and if you have a portfolio that invests in quality stocks and consistently growing stocks, I think you have a winner at hand over here. So that's essentially what we wanted to tell you. And with that, I would bring my presentation to a close, and we can start with the Q&A.
Thanks so much, Manish, for that interesting presentation. I've already had some questions coming in on my phone. So before we take them up, just a quick question. I personally have, just to refresh my knowledge. What would be the proportionate share of FIIs or foreign money versus domestic in the Indian equities currently?
So when you look at it, see, the story becomes very different pre-2016 and post-2016, right? Pre-2016, if you look at it, it was predominantly a market which was driven by FIs. But what changed was December 2016, when demonetization happened, and when you look at the inflows that started happening from retail investors into mutual fund in terms of SIP numbers, right, which is anywhere between 6 to 7,000 crores to start off with on a per month basis. Today stand at 10,000 crores, and we've seen the way AUMs have moved up. I think both play a very important role, but still predominantly FII driven market.
Right. So just adding on to that, then obviously you would be aware that US of late has been catching up with its inflation. In fact, I think it's beating its 2% target. So a slightly hawkish Fed, maybe early next year, could you think it could change the whole story around? I mean, if interest rates start to rise in US, and since FI still play a fairly significant role, do you think whole growth story? Because at the end of the day, we all realize it's more than anything else, it's a liquidity driven market.
Liquidity both from FI investors and Indian retail domestic investors, but liquidity driven market by and large.
So I think usually what we have seen, especially with regards to retail investors, they tend to follow. They don't lead the market. So once that tide begins to turn around, a lot of these investors would get jittery.
Yeah, more likely. But then the point here is, quite honestly, is that when you look at the Fed's behavior last time around when the GFC happened in 2007, 2008, the whole pullback started happening, I think, from 2013. It took 5 years for them to start tapering. Right. And this time around, they are much more swifter than that, and they're talking about a rate hike happening somewhere close to the early part of next year. And they are talking of next financial year, and they are talking about tapering of starting to happen as quickly as December this year. But my sense here is that they are going to be far more sensible about it than what the market would want to believe at this juncture. As far as rate hikes are concerned, am I, anticipating a very massive cycle of rate increase, and is the Fed going to become overtly very hawkish? I do not think so, because I do really believe that the inflationary concerns are a little bit more transitory in nature than sticky. what is going to lead to a decline in the inflation trajectory. And it has already started happening in US also in part, in way, if you see 5.8 has now come down to 5.3 or thereabouts.
Two, yeah.
And this will continue to move down because crude will play a big part in it. That is one big part to it, because what has happened is, through this financial year and through this calendar year, I think everybody has overestimated the demand scenario as far as crude is concerned. And we've seen the demand projections for CY22 continuously being downgraded, and supply continues to move up. And in that respect, I would expect crude to remain very, very range bound between 60 to 65, $67 or thereabouts from a long-term perspective. I'm not anticipating crude to go up at any given point of time soon. And that will play a very big important role. The second big thing is, a large part of the inflationary pressure globally has been fueled because of agro commodities and the weather-related problems that the LATAM countries are going through, and some of these supply chain issues. We've seen the Baltic Index movement, right? I mean, it has almost gone up 3 times in the last 1 year, which is something that has never ever happened before, right? But the point here really is that some of these supply concerns and bottlenecks are slowly going to move away as the world starts coming out of pandemic, and as more and more countries start opening, the trade will start opening up. Some bit of it is also because of the China port closures, etc. And again, these problems are going to be a little more transitory in nature. And third part is the whole metal scenario. And we've already seen metal prices, at least on the ferrous metal sided, both in Asia, in China, and in Europe, now starting to come down. So as far as rate hike is concerned, Korea has done it. I think Canada has done it. Russia has done it. And Australia is talking about it. Fed will probably do a token rate hike somewhere around next year. But I'm not going to be overtly, pessimistic. I'm overtly worried as far as the rate hike cycle is concerned. And as far as the tapering off is concerned, I think it's going to be a very slow, gradual process. Can there be a correction in the market because of that? Yes, possibly. I'm not going to rule that out, because, like you said, it's a liquidity-driven market. If there is a transitory pullback from the market, and the Nifty kind of corrects his suppose 5 to 10% from here onwards, I'll actually use that as an opportunity to jump in and buy more, because fundamentals from a 3-year perspective are very solidly in play. And we've seen that historically, that the worst times are actually the best times to buy. When everybody's panicking, that's the time when you should be bullish on the market. And very honestly, nothing other than the US Fed action at this moment is looking like it's going to lead to a significant correction in the Indian markets. Right. So it's only going to be the FIs pulling out. And if that as and when happens, I'm going to be waiting for that opportunity to actually personally buy more.
Right, right. Right. So I have another question. Any specific sectors that you think? I mean, obviously valuations are expensive all around, but any specific sector that you see is a good value right now, is a good buy right now?
Oh yeah, there are two that I have in mind. First is autos. Nobody's talking about autos at the moment. Everybody's ignoring autos. Everybody wants to get into metal. Everybody wants to buy SBI, PSU banks, this and that. And they're all stories which are done to death. Autos is a sector that is going through multiple issues. Think about it. There's chip shortage. Maruti is losing market share. Metal prices are at an all-time high. Price hikes are not happening. Rural demand looks like, it's a little wibbly-wobbly because of the rainfall being much lower than what you anticipated. And it looks like it's going to be at least one more quarter of pain, for the auto sector. The second quarter is also going to be a bit iffy before things start improving. But the point is, the question really that you need to ask yourself is, what's better? To buy Maruti at 6,500 and wait for a year, or to wait for 6 more months and then start buying Maruti at 10,000. I think one sector that really looks like a very attractive investment at this juncture, which is the most ignored sector, which is autos. And second sector where I'm going to be the most bullish on at the moment is going to be banks, BFSI. Again, a lot of concerns which are emerging out as far as BFSI names are concerned, which is number one, credit growth in the economy continues to languish at around 5 to 6%. The cash in the private sector has moved up almost close to double, 2x than what it was 2 years back, which essentially means that the capex in terms of borrowings is going to get pushed back even further. That means essentially it is going to take 2 more quarters of solid growth for the capex to come back. And the first leg, you'll see the existing cash being exhausted before they start borrowing again.
Right.
So you should expect a meaningful pickup in credit growth only in the second half of next financial year. And
Right.
that's essentially one of the reasons why private sector banks have started, uh, uh, being a little range bound of late. There is at least one more quarter of pain, and then there are some more concerns about MSME, bad loans springing up at some point of time because of the second lockdown. And when such concerns emerge out, and you see the way PSU banks have rallied and the way private sector banks have kind of underperformed, I would be very inclined to actually look at private sector banks very favorably from a 1 to 2 perspective. I feel there is a lot of money to be made there.
Also, insurance and asset management companies. Any view
And
on?
insurance, of course. And insurance, of course. And
Right.
also technology. Sorry, that was another one that I missed. IT is not done yet. IT is going to continue to rally in the way it has in the last 1 year for at least 2 more years. So there's a lot of money to be made in IT as well and insurance. Absolutely.
Right. So I something similar. What are the sectors that you're most optimistic on? Obviously, these are the sectors that you feel are good values. Any specific sector that you personally like the most right now?
No, so I like pretty much everything. But
Right.
if I were to put my own personal bias, and I think discretionary consumption has a long way to go. That's one sector that I'm very bullish on. IT is another one big bias that I have, positive bias that I have, and BFSI. And one sector that I'm very negative on and which I feel is done for at least the next 3 to 4 years now, is not going to come back in flavor anytime soon, is FMCG, which is staples consumption. I think that's done. That's a sector that's built for world.
Right. Right. Ironical, you say that at a time when ITC has been rallying the way it has been past 2 days.
Ah, it's high time, right? I mean, it's essentially
Yeah.
giving us an insight. It's telling us that it's time to sell.
Yeah. Yeah. It's giving maybe giving us an opportunity to make some good profits. Right.
Yeah,
So,
and
another question.
ITC is going to go to 280. Believe me, ITC is heading to 280 by December, and that's the
Right.
time we should just hit a sell button and get out of it.
Okay. Right. So another question. Any view on small and mid caps? They've rallied a lot. How do you see them going forward?
Uh, See, there is a little bit of pain as far as small and mid cap is concerned, and you saw that in the first chart, right? This year so far, I think this calendar year, Nifty has run up by 20-21%. The mid cap index has run up 2x of that, and the small cap index is 3x of that. Right? That sums up the whole story.
Right.
What I do believe is that there is going to be an intermittent period of underperformance because liquidity flows back in the system in the way that it has in August and so far in the first half of September. Clearly, FIIs are going to run after large cap stories first, and they're going to avoid the mid caps and the small cap sort of point of time. But if you have a 2 to 3 year view, then quality small caps and quality mid caps, you still have a lot of money to
Right.
avoid bad quality companies because I think the penny stock index is done. It's done. The top has been made. I have a very strong view that it is not going to rally anymore. Incrementally, return generation is going to be very difficult in mid caps and small caps from this point of time. So stick to quality stocks, and there is a lot of money. Be
Right.
judicious about it.
Right. One final question. So, what are the biggest challenges as we sit here today? To the markets. What could go wrong, and how could that have a negative impact on where we are today? I mean, while everything looks very positive,
Yeah.
looks very exciting, uh,
Yeah.
risk, and how do we manage that?
See, the this was a question that came to my mind in May 2014 also. That everything looked so hunky dory. It was supposed to be a dawn of a new India, right? It
Right.
was supposed to be era in the Indian economy which we have never seen before, right? And that's a story that we were sold. And if you think about it, since then what we've done is we've peddled the India growth story. Every year we are saying that the next year EPS growth is going to be 20%, and it
Right.
eventually comes at 4%. And we have been continuously disappointed for 4 years in a row now. So I think the only thing is that what really gives me a lot of sleepless nights, and that's something that you have to worry about. I'm not too worried about inflation. I'm not too worried about disinvestment target being missed. I'm not too worried about monsoons also. I'm not too worried about the Fed action also. But what really is one of the biggest worry in my mind, the paramount on my head, um, is a 6 sigma event scenario, which plays out in India now so often. Every year, there is one event in India which happens, which you would have never thought will happen in your lifetime. We started with demonetization, the GST implementation fiasco, the 94,000 crore fiasco in ILFS, then the
Right.
auto sector we did the way we did, and then the pandemic came upon us. In the last 5 years, we've seen five, six sigma events. And
Right.
this whole dispensation has this habit of springing this surprise on our head every now and then. And that's something that I'm going to be very wary of, because it all hinges on status quo, things being as they are, the way we see them today. That's
Right.
a big issue.
Right. Right. Right, Manish. With that, I think I would like to thank you for sparing time out and addressing our audience. I think you were very honest, very candid, and very upfront with whatever you feel.
So thank you for having me. It was a pleasure, talking to you guys. The questions were insightful, and I had a lot of fun in making that presentation, because
Right.
nobody really asked me a question like this. It was a very specific topic that was given to me,
Right.
and you guys were very insistent that I choose that topic, and it was quite challenging. It was quite interesting. So it personally was a big knowledge gain for me also to work on the topic in the way I did. So a big thank you to everybody.
No, I think that comes purely from all our practical experiences of sitting in front of clients every week, every month, and being faced these questions all the time. So I thought, so a lot of our clients are attending this presentation today. So hopefully, a lot of their doubts would have been answered. Thank,
Yeah.
thank you, Prithvi, for organizing this.
Most welcome.
To all our participants, in case any of your questions remain unanswered, please do reach out to us through your relationship managers or through our website. With that, it's a wrap on this edition of Master Talk. We would see you all again soon. Thank you so much and bye bye. Bye, Manish.
Bye. Bye.
Thank you, Angad. Thank you, everyone. Thank you.